All right, gentlemen. Guess we'll go ahead and get started. I want to, first of all, thank everyone for joining, and thank Sean for always jumping in and providing guidance and support, and to Jewel and Jay once they arrive as well. And even if they don't, definitely thanking them in advance for the opportunity to present and share with you guys and also learn from you as well. So before we get started, I'd like to, for those of you that haven't met me before or don't know me, my name is David Council. My background is in finance in a variety of areas. My most recent and current experience is within corporate finance. I do financial planning and analysis, budgeting, and mainly supporting our Medicaid book of business with the District of Columbia. And pretty fun stuff. It's a lot different than what I did in previous positions. I've been in this position, my current position, for I would say probably about 6 months as a lead, and what I do is coordinate with other stakeholders throughout our enterprise to gather necessary information for forecasting and planning, in addition to my other duties. Prior to that, I was a senior analyst, had been for a number of years. Before that, consulting within the finance and accounting space with the Department of Homeland Security and the Department of Defense through a government contracting consulting company. Before that, banking, specifically corporate and commercial banking. Before that, primarily trading and asset management. And that was right out of school, so fun years, but definitely different than what I do now. When I say trading, so it was a commodity trading with futures, and then went and joined the bank as a junior analyst, got bored, came back, and did still in the commodities market. It was in Chicago, and most of the stuff in Chicago that is traded is commodities. And so when I came back, went to options, and then after that, before I went back to school, I was a junior trader at an asset management company, managing and executing their trades for their long, short hedge fund and their in-house long-only mutual fund. So that's a little bit about me. I chose debt because, out of the myriad areas within this private equity and VC space that we've decided to join and build with each other, my most familiar areas are trading and investing, and then debt specifically because of my years at the bank and working on transactions with that. So that's why I chose debt, and it has so many different and far-reaching areas that people use it as a financing tool, in addition to equity, to facilitate deals. Deals being acquisitions, deals being leveraged buyouts, any sort of funding is, we'll get into it. There's a variety of different sources of capital that you can use to finance a deal. And so that's why I chose that, is familiarity with the space, the products, not so much a background as a GP or LP, but the product. So if you were to facilitate a transaction, you would reach out to me. You would say, I was either a coverage specialist or product specialist, if you will, like let's say debt capital markets, if it was an investment bank. That's what I would call this. So anyway, any questions before I get started about the background or what we plan to do here today? All
No
right.
questions, no questions just yet, but definitely will circle back and pick your brain and ask you about how you feel about the current market structure, where SPY is at, and futures, all that type of stuff. But I'll save that for another time.
Okay. Okay. That works. That works. So yeah, so we will jump in as the title of the presentation suggests. The first part is debt instruments. The second part is applications within PE and VC. So I will start off with debt instruments and keep it pretty high level. My intention with this cohort with respect to debt is to have this session and the maybe subsequent 2 or 3 sessions around what is debt and the mechanics of it, and eventually bringing in some folks that are specialists or have worked on transactions or are GPs or LPs that use these instruments currently to facilitate deals. But with that said, debt instruments. And so what you see in front of you is an illustration of the capital stack and positioning and where debt fits in that capital stack. I kind of like this chart. I was looking for one that was a little bit more in line with how I view things, but this one will suffice. We start at the top, and if you're reading along, it's grouped by position. And what that means is default positioning in the event of bankruptcy. So the top one, and the reason why I like to look at it from the other way around is because that's how bankers look at it, and most people should look at it, but all the charts are arranged in this way. Didn't really have time to do one by hand and arrange it myself. But anyway, so the lowest priority is your investment, which it says up there, it's illustrated, which is equity. The highest risk has the highest return, highest expectation of growth and profit. That includes your typical stock equity. So so stock, warrants, options, any of those types of vehicles would be considered as equity. And most people get into them for what's stated up above, which is growth and expectation of really high returns. However, it's low risk. It's extremely high risk. And in the event that the entity that you're investing in defaults, then you have the lowest priority of position of recovering your investment. The second one is preferred equity. It's sort of like a hybrid security. A lot of times people that are on the VC side, they use the equity, which I just described, which includes options, warrants, and stock, restricted stock units, and things of that nature. But preferred equity is also used. It has a higher priority or higher position than equity, meaning if the company defaults, then you have a higher claim than common equity or common stock within the capital structure. Reason why it's a hybrid security and sometimes could be considered quasi-debt is because preferred stock pays dividends, which is, generally speaking, cumulative, or it could be non-cumulative, but that's it. And it's as it shows here, has a higher interest rate, generally speaking, than you would get with common equity. However, what you don't get is the growth. So if you looked at a company, the preferred stock from say, Duke Energy, which is a regulated utility here in the southeastern region. They have preferred stock and they have common equity. Same thing with a lot of banks. They have preferred stock and common equity. Well, if you got Duke Energy preferred equity and you have Duke Energy common equity, even though Duke Energy is a regulated utility and the growth rate is slow, you'll still experience higher capital appreciation than you would with the preferred equity. But the Duke Energy equity has a higher dividend yield, and depending on which level of preferred equity they issue, it could be cumulative or non-cumulative, which means if they don't pay a dividend for whatever reason, then they can't pay a common equity dividend until they pay their preferred equity dividend, which makes it a higher priority and higher position in the capital stack. It's often used in VC deals so that people don't give up too much equity. So if I'm a founder and I want to fund my company, I need to say $100 million. Well, a portion of that I would do, let's say maybe 20, if the people that I'm seeking funding for would allow it. I would do preferred equity in the cap table, so that way I could pay a preferred dividend, but I wouldn't have to give up any common equity, which includes most of the time voting rights and things of that nature. Preferred equity does not have any voting rights. The next level is mezzanine debt. Now that is actual debt. It has no equity component to it, so you have zero growth. That is that bucket where I'm sure a lot of you have heard recently, where it's been this explosion since COVID 2020 in private credit and direct lending. And so that's where that bucket would fit for a lot of folks. In terms of priority and position, it is higher priority than common equity, preferred equity. However, still has risk. The interest rate is higher. So let's say if you did a preferred equity issuance, you would, let's say you did like maybe 6% to 7% on your preferred equity that you would pay to your investor every quarter for the funding that they would give you. The return that you would get them would be 6%. Mezz debt, it would be 7 to 8%. However, you do have that security. So from an investment perspective, if I was to do a mezz debt deal, I know that I would get my money back because, I don't know for sure, but if the company defaults, then my position is higher than preferred equity. So while the rate is slightly higher than preferred equity, slightly higher, it's still going to be lower and less risky. Your risk profile is lower than preferred equity because you get paid out before preferred equity, before common stock, and the percentage or the loss given default would be higher. LGD. So usually, if I say that later down the line, that's what that means. So LGD is loss given default, meaning there's a default probability for company X, and if I'm an investor, I'm like, okay, if their default percentage is let's say 70% default, and the recovery rate is like 50%, and I multiply those two percentages, then I can forecast that I would recover maybe 45% of my money. So that's that one. The final one and highest priority, first position, is bank debt. And that's let's say if you go to Wells Fargo, you go to any of the banks that you're probably familiar with, Citibank, Goldman Sachs, and I'm not talking about their investment banks, it's just their commercial leverage lending corporate bank side. So on here it says foundation loan heavily regulated. It's definitely heavily regulated because most of the banks are national association banks with national charters. They have the lowest risk because they're first lien, and then they have strict recovery rights. So when I talked about the loss given default or LGD, that's what that means. So that's why I like to flip it, and I like to start from the very top all the way to the bottom, because the way I look at it is, if you're on the bottom, then you get the crumbs. If a company defaults, these guys right here are going to get paid first, then these guys, then the common equity last. So next slide here. What are you guys seeing on the, there we go, okay. So back to the full capital stack, right? So now we're gonna look at debt specifically. So we covered common equity, preferred equity. So then let me give you a brief description of senior debt and then sub debt. So senior debt, again, that's the one that is at the very, again, if you flip that last one, if you invert it, that's at the very top, meaning they get paid first. If a company defaults, they get paid first. And that usually is composed of a revolving line of credit, which is like a credit card for a company. Term loan A and B, which is like getting, not a mortgage. I know the other slide said mortgage, but you get a term loan from a bank, then that is usually like getting a personal loan from a bank. Like if you were to go to, let's say, I don't know what banks they have where you guys are, but let's say you went to Bank of America, you went to Penn Fed in DC, or you went to, I don't know, Navy Federal Credit Union or something like that, and you got a personal loan. Usually the duration of personal loans is anywhere from 5 to 10 years, but most cases they're not longer than that. Or auto loan, usually between 5 and 7 years. Auto loans usually don't extend past 7 years. So that's the typical term when you're looking at a term loan as a bank form of financing. So if you, the borrower, I'm going to give two perspectives here. So if you are the borrower and you go to Wells Fargo and you want to get funding for a deal, let's say you found a company and you want to purchase the company. So that's a transaction type. You want to acquire, that's an acquisition. You want to acquire a company. Well, a portion of the financing will be a term financing. Term loan if you went to a bank. And then another portion would be a revolving line of credit. You will probably want to do that because you're going to need to, for the company that you're acquiring, you're going to want to have some sort of working capital funding to cover working capital needs. And so that's if you're acquiring a company. If you are a company yourself and you just say you're just an operating entity and you have the PE fund, you have your portfolio of companies and you already did the transaction and you want to recap one of your portfolio companies. So that would be a debt recap. And so you acquired the company, it's like 3 years later, and you want to exit, you plan to exit in 6, so you got 3 more left. Interest rates are declining like they are now. So we're going from, Fed funds rate of 5.25, and now we're at 4 3/4. And so what you want to do is you want to refinance. You're 3 years into your deal, that you had an acquisition 3 years ago with this portfolio company. Interest rates are down, so you recap your acquisition financing, and I'll get to sub debt, but you take out the sub debt, you refi with bank-only senior debt, you reduce your interest rates, and you keep your revolving line of credit because you want to make sure you keep the liquidity in place for this operating entity. So that's on the portfolio side, portfolio financing, acquisition financing, and then if you're an operating company, you might want to acquire some new equipment. Let's say you've been in business for 5, 10 years, maybe 10 years, and you have some equipment maintenance and financing that you need, maintenance that you need to do or refresh. And so these are some reasons why you would use debt financing. You could use equity financing, but it's more expensive, as we mentioned. So what I've experienced is, companies will use term loans to finance the purchase of new equipment. They would also use term loans to finance capital projects in general. And then they use revolving lines of credit for working capital needs if you're an operating entity. So term loan A, more restrictive. When I say first lien, what that means is when you book the loan, let's say you book a loan for $100 million, and let's say, both of them will be first lien, but anyway, so typically what happens is, let's say you do a $150 million transaction, 25 million to 50 million, let's say 50 million would be a revolving line of credit. The revolving line of credit would be collateralized, meaning it would be secure. So within senior debt, you can have senior secured and unsecured. Secured means you put up collateral for the loan. So if you are a company that has receivables, so let's say you're a subscription-based company and you sell software subscriptions, and you have people that pay a monthly fee, like thousands of people that pay a monthly fee, but you need to free up some cash flow, or at least have, maybe not free up cash flow, but maybe you just want to have more flexibility with your cash flow management. You could take the revolving line of credit and have it collateralized by the accounts receivable, because that's what it's for anyway. And so let's say maybe you have a longer cash flow cycle. So instead of subscriptions, you have, let's say, you're Caterpillar and you're selling capital goods, right? And so you have an inventory build-up cycle, and then you sell these big earth-moving machines. Well, you might not get the money after you invoice. It could be, 30, 90 days or so, right? Well, in between that time, you still have to make payroll. But based on the invoice and the equipment, the earth moving equipment that you just sold, that you're going to have 100,000 coming in, 200,000 coming in. And let's say you did 10 units, so that's $1 million coming in, but you still got to make payroll. So that's where the revolving line of credit comes in. They take that receivable as collateral, and they give you a loan against that. And that receivable is called your borrowing base. And so if you have 100 million in receivables, if the bank feels like they're solid receivables, and you don't have any problem with collecting them, and you don't have a whole bunch of accounts that are 120 days past due and all that, then they will loan you like 80% on your receivables. So that means you can get a revolving line of credit from the bank for, let's say, $80 million. And in this case, it's collateralized by 80 million in receivables, but you only draw on 50 million at any given time to cover your working capital needs. So that's the first part. The second part is the term loan, right? And so we're sticking with Caterpillar here. So you Caterpillar and you're like, okay, well, I want to expand production and I need 100 million of that to do that. So you take the 100 million term loan, 5 years, amortize over that 5-year period, and you're done after the 5 years. Boom. Term loan B, second lien, what that means is it's subordinate. So if you default on the loan or any of your loans, term loan B is second in line to term loan A. And even though it's level amortization with similar duration, usually what happens is the amortization schedule is structured so that your monthly payment doesn't pay off the full loan by the end of the maturity of the loan. So if your loan matures in 7 years, the amortization schedule pays it off in 10, which means your payment is lower, but in 7 years, you'll have to pay the full remaining balance of the loan. So that's what bullet payment means. So that's bank financing. It could be secured or unsecured. And like I said, if you have really good credit, just like a credit card, like if you think of all of this like in a scheme of like you're a person or individual and it's just credit cards and personal loans, it's the same thing. So auto loan, personal loan, same thing. This is like a credit card just for your business. Doesn't matter how big or small the business is. If you have good credit, you can get an unsecured credit card. Most of y'all don't have a secured credit card. If you have bad credit, there are companies that will allow you to get a credit card. You open up a bank account, you put $300 in there, they secure the credit card with that bank account. Once your credit improves, then they release the collateral back to you, and then you have an unsecured credit card. Same thing. Here, you could get an unsecured line of credit, you can get an unsecured term loan. It's not always secured, but most of the time, it is secured if it's a term loan. Let me go back. So yeah, most of the time it is secured if it's a term loan. What they secure the term loans by is what's called PP&E, which stands for property, plant, and equipment. And so if you are financing equipment, if you're making an upgrade or expansion or whatever capital project is, then that equipment is also included in that collateral pool. But again, a lot of times you can get a term loan or bank financing that is unsecured. The second one is sub-debt. So when I say sub-debt, it's multiple types of sub-debt under here, but we'll just focus on the most common one, which is commonly referred to as mezzanine debt, which we talked about earlier, which is similar to term loan B, but lower priority in the capital structure, meaning this is your bank debt. If you go in with mezz debt, you're going to get paid after. And so if I'm a lender and I'm giving you the money, then my risk is higher. So if I'm a direct lender in the private credit space, then my risk with you is higher because I'm lower in the capital stack. If you default, then I'm going to get my money back, but maybe not all of it, and I'm going to be way in the back of the line. I'm still before these preferred equity and common equity, but I'm still in the back of the line. So I got to charge you more. So the interest rate is going to be higher. The terms, though, they'll be stricter than it would be with these guys, but less strict than bank financing because it's less regulated. And that really is what has led to the explosion of private credit over the last 4 years, because playing in this space is a lot easier because banks they have their hands tied. For as much as they want to lend, it's just really hard for them to do it in a profitable way where they can, do it and not be hamstrung by regulation. So here's an example of a term sheet where this is like revolving line of credit with a letter of credit, $2.5 million, and be used to fund working capital, limited to commitment amount, interest due monthly. So meaning it's an interest only situation, and the principal is due in a year from closing, and it's unsecured. Covenants, none. Here, let's see, upfront fees, TBD, is negotiable. Like sometimes you have a free, just like with when you buy a home, and when you look at financing, it's just like anything else. If you go to the bank and you get a personal loan or mortgage or whatever, there might be a fee, origination fee or a closing fee and all of that. Same thing here. That's negotiable. Pricing is usually, well, now this is a pretty old document here, but LIBOR, which stands for the London Interbank Offered Rate, overnight rate, that went out in 2023. I think they sunsetted it 2022, 2023. So it's recent, but that used to be the benchmark for pricing, but now it's SOFR, which is the secured overnight funding rate from the Fed. So that's what people use to price loans now. I'm not going to get into the benefits and drawbacks of that, but that's the benchmark now. And so what that means is the rate may be fixed for the term of the loan. So how that works is, and this is our credit cards, our price, because they're floating. This is the floating rate. So revolving lines of credit and credit cards are floating rate loans. Term loans are fixed rate loans. What that means is you get SOFR, whatever SOFR is right now. I think SOFR is pretty close to the Fed funds rate, which is like, I think SOFR might be right at 4.5%. So you have 4.5% plus a fixed rate on top of that of, let's say, 100 basis points. Basis points are percent. So if I say 100 basis points, that means 1%. If I say 50 basis points, that's 0.5%. So if you were to get a revolving line of credit, let's say SOFR at 4.5% plus 100 basis points, then that is 5.5%. And so if SOFR goes down, then let's say, so when the Fed lowers rates, let's say the end of next year, SOFR is down to 3.5. Well, your rate on your revolving line of credit will be 4.5, because remember, your rate is your fixed 100 basis points plus whatever that benchmark rate is, which in the case is SOFR, so it'll be 3.5 plus 1. What you need to do is provide financials and any other terms and conditions for the bank may apply. So next, I have some examples. Now I'll wrap up in a few minutes and go through these pretty quickly. The acquisition scenarios, we can go through these in more detail, I guess, on another session. But if you want to use debt to finance, most of the time when it comes to private equity or acquisitions or LBOs, anything like that, it's leverage financing. And what that means is you're using a little bit of your money, if any, and then you're using majority debt, which includes bank financing and mezz debt or some other combination thereof. So what does that look like? Well, if you, the key assumptions are here. If you want to purchase a company and you're going to pay 7 times EBITDA. EBITDA stands for earnings plus earnings before interest, taxes, and depreciation. That's a common multiple used for most stuff. So purchase prices as a multiple of that. So of course you would have done your valuation ahead of time and been comfortable with the target that you're acquiring. As the acquirer, you say, okay, well, 7 times EBITDA, I'm going to fund it with debt. Here, I don't think I finished the rest of this. Finish typing this out. So EBITDA, so pro forma EBITDA equals the TTM EBITDA plus your purchase price EBITDA. So what does that mean? So we got a small acquisition, we're gonna use debt. You came to me, you said, hey, well, this is what we wanna do. Found a company, we like it, and we know we wanna go with, let's say, Wells Fargo for the debt, and we don't wanna do any other debt, we have good credit, let's go. And so the target company is $3 million in EBITDA. And so you're gonna pay 7 times that, that's your purchase price, and you're gonna use leverage, so debt of 1.5 times EBITDA. So then you get the new senior debt. This is what this looks like. So a transaction, the way it works is you have a sources and uses table, and the source is your source of funding. The uses side is what you're using the funds for. And so we have senior debt, 20 million, and then your purchase price is 19 plus the expenses for total uses of 20. If you look at the bottom at the pro forma cap table, you see the acquisition of 20 with the senior debt, then you have your shareholders' equity, and then 26.8 for your total cap. And then if you look here, you have 1.5 times for of debt. So that's your new senior debt multiple. It's 1.5 times your pro forma EBITDA. I don't know if you guys could see that. So EBITDA is 13. In this case, how do we get there? Well, we have our trailing 12-month EBITDA. So we are the acquirer. Our trailing 12-month EBITDA is 10 million. So we take our EBITDA plus the 3 million in EBITDA that we have acquired for a total EBITDA of 13. And so the debt that we use to make that purchase is 1.5 times the total EBITDA. So all you're doing here is dividing 20 by 13. And so you can see as we go through the different stages, 6 million target EBITDA, take that, and then you have the 10 trailing 12 month plus the 6, that's our total EBITDA. So our EBITDA plus the 6 we acquired. We took 45 million to do it. Purchase price was 42, that's how much we paid. How did we get to the 42, you might ask? Okay, it was multiplying. So we're taking that 7, right? And then if you take that 7 and you multiply it by 6, that's how you get to the purchase price. I know somebody's probably thinking that in their head, like, how did we get to the purchase price? Well, that's what we talked about up here with the assumption. So we're going, for each one of these deals we're doing, we're paying 7 times EBITDA. So 7 times 6 is 42, that's your purchase price. Took 45 in debt to finance it. And then your consolidated EBITDA is 16, your debt is 2.8 times that. And this is where we get to, and we'll go into the next slide, we'll talk about leverage transactions. So you have, again, 7 times your multiple. So it's like 70 million or so. So in this case, a little bit more than 70 million. So 7.5, so 75 million. And this one, we're breaking out our senior debt, which is that first lien bank financing. And then we have sub debt, which is mezz debt here, 1.5 times, for a total of 80 million in debt. Because we're doing mezz debt, remember I told you it's more expensive. Not only are you financing more, but you're doing a combination of mezz and bank financing. So your fees are going to be more and your interest is going to be more. So your total fees are 75. Total uses is 80. Purchase price 75. you got 10 trailing 12 months for you, the acquirer, and EBITDA, and you bought 10 million in EBITDA with this acquisition. So your total EBITDA 20, your multiple of debt on top of that EBITDA is 4 times. How do we get 4 times? Well, you have $80 million in debt and you have an EBITDA of 20, 80 divided by 20 gives you 4. That's where you get into the leverage territory. So from a regulatory perspective, from the OCC, Comptroller of the Currency, the Fed, and regulated banks, when you get to 3, then that's when you're in leverage territory. So 3 to 4 times EBITDA is like leverage lending. And I know we're bumping up on time here, so I want to leave some time for questions. But when you do that on the bank side, usually what happens is you end up doing syndicated deals. A syndicated deal is a deal where you'll have a book runner, a lead book runner, say like Wells Fargo, Bank of America, Capital One. You have a lead book runner, and you'll have 5 people on the deal. And if we did, let's say, this one, it's a bigger size deal, and the bank debt is 50 million. So if you had 5 banks in the deal, Wells Fargo is the lead book runner, they might take 5 million or 10 million, and then they'll spread the 40, the remaining 40. They'll take the biggest piece, so they'll take 10, and they'll spread the remaining 40 amongst the other banks. And so that's how that will work. They'll get the biggest fees as the book runner, and they'll have a nice tombstone. So that's how that works with bank finance. And once you get into the leverage side and the deals get bigger, one of the reasons, again, going back to mezz debt and the explosion of direct lending and private credit, is private credit can lend above 3.5 times. They can lend above 4 times. They can lend, they could go up to as many times as they want. They usually won't, but they'll get around 5, 6 times leverage, and they won't hit you over the head with covenants. It'll be covenant light, if you will. It'll be slightly more expensive on the interest rate side, but a lot of folks find that it's worth it because they don't have to go through the regulatory hurdles with the banks. The banks are hamstringed, and they want to, but they can't. And then even if they could, in some instances, they just don't have the risk appetite to do a certain size of leverage loans above 4.5, 5 times. So that's one of the drivers for that explosion of private credit. So if we go to we got like 2 more slides left. Okay, so segueing into the LBO, this is an example of like a deal where you have a whole bunch of different types of financing. So this is try to throw as much stuff in here as possible. Obviously, depending on the complexity of the deal, you have like a whole mix of stuff, but it doesn't always work that way. But you have the revolver, your term loan A, B, senior note. That could be senior unsecured. So in this case, you could have bank financing secured, term B secured, different amortization schedule. Again, this is the LIBOR plus, or in this case now it'd be SOFR plus their spread. Then your senior note, that would be senior unsecured note, subordinated note, and these would be publicly issued or privately issued. When they say notes, talking about like a debenture or a actual bond agreement where it's underwritten and sold. So you can have, so like CVS, for example, they have bonds where, people talk about bonds all the time. You can go buy bonds. That's what this would be. So this would be like senior unsecured, publicly issued notes or bonds or private placements. Mezzanine, this could be direct credit, like private credit. And then seller note, didn't get a chance to really touch on that too much, but seller notes are, I'm gonna give a mortgage example. I own a house, you're buying a house from me. You don't have enough credit to fully fund the purchase. You're buying a house from me for $500,000. The bank will only give you $400,000. As a seller note, what we agree to is I will provide you the remaining $100,000 to cover the purchase price directly, and then you will pay me back. So in that case, I won't actually give you the money. We'll sign a promissory note, and then you pay me back. You pay the bank back their $400, and then you pay me back $100. But I never actually gave you any dollars. It's just a promissory note that you agree to in lieu of the cash purchase price of $100. You would pay me in installments of whatever toward that purchase price. And then here goes our preferred stock, which we talked about. And this is where, when we talk about private equity, leveraged buyouts and acquisitions and things of that nature, this is where the funds that you have raised from your limited partner sponsors, limited partner investors, this is where this would go in an acquisition. So you as a GP, you're sponsoring an equity buyout, a private equity buyout to acquire a portfolio company to put inside of your fund. This is where that money is placed in the capital structure. And then going back to what we talked about earlier, this is like your sources and uses piece. You have the source of funds, and then the use of funds, which is this goes to the existing shareholders to purchase the equity, and then you're assuming a debt that they already had of $230 million. And then this is just some statistics of how people would be looking at it, like you as the GP, you as the LP from the investor perspective, me as the bank if I'm participating in the deal, whoever is looking at the deal, whatever role that they're playing, everyone is looking at or would be interested in these statistics. What is your total debt coverage over that time frame? Obviously, you want to see this going down. You see it in year one at closing. By year 5, you expect that total debt to go down as a multiple of your EBITDA. Same thing with the senior debt. That's me. That's where I'm at. I'm the senior debt. I'm the bank. Your net debt is your debt minus your cash. So obviously, this is going to be the lowest because you expect to generate a whole lot of revenue and obviously a whole lot of cash flow from this deal. Interest coverage. I would love to see this as a senior debt, as an investor in a senior debt position, or as a bank, where I have interest coverage that's super high in the first year. That subsides, because what generally happens is you're giving cash out to the shareholders. So as a portion of interest coverage, your EBITDA that is for interest coverage sort of goes down over time as you more equally distribute the EBITDA across your firm investor base and reduce your total leverage. This is illustrated by your pay down here. And then this is what it would look like at closing. So you start here and then you go from left to right there. So this is a summary of all the debt that we just had up here. And then this is like a summary of all of that. So yeah, I think that's it. Any questions?
Hey, David, thanks for the webinar, man. That was a lot of good information, and this helps me a lot with what I'm doing currently. We're working with investors, so I know exactly how to set up what I'm asking for. And definitely be in touch with you, my brother. I really appreciate your time. Okay.
Oh, absolutely, absolutely.
Me
Yes,
too,
sir.
David. This is Barry Broxton. Well, I represent a private equity group. We probably have right now $6.5 billion to deploy. So I'll be reaching out to you. We definitely go off the SOFR plus maybe 2.5 the highest for multiple of 4 to 1. 100 million get you 400 million. 1 billion get you 4 billion. Under the 100 million is 3 to 1. 10 million get you 30 and so forth. But we are totally a debt equity company, so we're non-recourse. We do have a 4 to 5 year interest-only payment. So I wanted to talk to you about what you're doing and see if we could collaborate on some deals that if you have in the pipeline that maybe we could help. Yeah, I gotta get rid of this $6.5 billion. That's all I gotta say.
Ah, I love it. I love it. Well, yeah, we could definitely talk and see what we can come up with and kind of go from there. But yeah, that makes sense. That makes sense.
Yes, sir. Thank you, sir.
Absolutely, absolutely. Thank you for attending. I appreciate it, and thank you for sharing this. Quite an endeavor. But yeah, I will reach out to you directly if you don't reach out first.
Yes, sir. Will do. Thank you.
Absolutely. I think Justin, you had mentioned you had a question as well earlier.
Yeah, I just wanted to, thank you again for, for your time and kind of going through that, looking at the different multiples and how it all kind of breaks down between, who gets the piece of the pie. But right now, for a lot of us who maybe just started our career not too long ago or kind of just started watching the markets, 2020 was a big kind of drop in the bucket, and now between futures, the actual market, commodities, everything has kind of exploded. And even if we take this offline, I just wanted to see where you thought, is it all in the charts, or are things just getting more expensive and that's how it's always been?
Yeah, good question. And yeah, we could definitely talk a bit more offline, but just in broad strokes, with this rally recently post-election, I think that is a bunch of irrational exuberance, if you will.
Mm-hmm.
I think there'll for sure be a pullback because valuations are stretched, given the global demand. I think, usually I like to look at it from the top down, and I do combine bottom up with my top down approach, but I usually start with the top down. And given China being so stimulative, they've had growth over the last 10 years that has been astronomical, but now they're only looking at 4 to 5%, if that, and then putting all the stimulus into the market. And so that's going to have a delayed impact, just like the Fed stimulus has lagged impact effects. But between now and the next 12 months, though, before all that happens, demand is, and so that's why commodity prices have drifted lower, because we like to think of America as being the everything, but at the end of the day, we are not. We're a big piece of it, but we're not the largest consumer by any stretch. And so with China being weak on the consumption side, generally speaking, if they're not buying the commodities, the additional supply that we're putting out, then that's why you'll see a drift in commodity prices across the board. From energy to agricultural to metals, everything. Now, gold drifted higher on inflation expectations, higher expectations based on inflation and higher tariffs and the Fed reducing rates, which is inherently stimulative, and China is being stimulative as well. But what also is happening is these treasuries around the globe have been increasing their gold holdings as the debt, not trade deficit, but the debt of the U.S. increases, and most of the developing countries, their debt as a share of GDP is increasing significantly. So that has happened too concurrently, which is like a structural shift that's a lot different than a temporary inflationary 12-month sort of shift. So I see gold being structurally higher, probably pulled back, but structurally higher for those reasons. But commodity prices overall just kind of lower over the next 12 months because the China demand is going to take a while to come back. It's near pre-COVID levels, slightly above, but nothing to justify the prices that have been around in all the markets for some time. Equity prices, we'll see if these companies can earn their way into the valuation multiples, but the multiples are well above average on higher growth expectations around artificial intelligence. And, these companies have been increasing their CapEx, almost exponentially over the last, 24 months. But, the question is, will they see ROI on that? And they probably will, but will it be enough in their earnings to reflect or justify the expansion in the multiples? So we'll see. So yeah, I'm equity market neutral. I think we'll go higher through probably January, February, just because of seasonality. And then January, February, we'll have more certainty in terms of what will be able to be passed in terms of tariffs. Those executive actions can go in place right away once Trump is in office for the China tariffs, which would be a substantial portion of tariffs against imports, which will increase prices for import goods for U.S. consumers. So prices are going to go up there. But the across-the-board tariffs, I'm not so sure if that'll get through Congress, even though Trump will have the majority of the Senate and the House. So we'll see. And then the lower corporate tax rate, that would benefit small caps and new businesses more than it would large cap or mega cap publicly traded companies, only because their effective tax rate is almost 0 to maybe 5% anyway. So a lower corporate tax rate is not going to necessarily benefit them as much as people are thinking. So I'm just trying to figure out, and I'll know more. I'll have a better idea, come January once stuff starts getting through Congress, what the net impact is going to be. But I don't think, at least initially, I think it's going to be a lot of pain. I don't think initially the tax cuts and Job Act extension and the lower corporate taxes will be enough to offset, increases in prices due to the new tariffs. But we'll see. That's kind of my take.
Okay, thank you. No, I mean, that was definitely, a well thought out response, and I'm sure there's a lot that you didn't say, so I appreciate that.
Oh yeah, it's a whole lot. It's a lot of bubbles. I'll say this: there's a lot of bubbles. There's animal spirits. I think people are really going risk on, not full risk on mode, but definitely risk on, selling treasuries, interest rates hadn't creeped up too much. They did creep up a little bit, but it's twofold. Like when interest rates go up, that means, you know, on the long end in particular, that people are selling treasuries and they are getting out of lower risk assets and getting into riskier assets. But that also means that, you know, you have that group and that driver, but then you also have the people that are selling bonds from a rate perspective, so like bond traders and people that are pricing bond and interest rate risk because they expect rates to be higher because of inflation and higher growth. So there's two things going on there, but I just think, you know, going back to your question about, you know, things being high in general, real estate prices, you know, until there's more supply, I think that's going to stay stuck even with interest rates being reduced going into 2025 and throughout 2025. That's just going to make, that'll unlock some existing home supply, but I'm not sure it's going to have the desired impact of increasing transaction volume at a lower price, which is, I think, people's expectation. But the price point of houses will probably stay elevated until there's more supply or a demand shock. And the only thing that I would see that would create a demand shock would be an actual recession, which is just so much money in the system. I think that's my biggest thing. It's so much money in the system. I don't know if you guys are open to how much time you have. This won't take long, but if you guys are into economics and like thinking about, you know, what really, and this is just like my sort of view on things and why things are elevated and will continue to stay elevated for an extended period of time, is because of the money supply and the funds that have been pumped into the system due to COVID. And we had it's like you go to the doctor and they give you like penicillin for a headache. I'm like, well, why would you do that? I'm like, that, you know, that's the wrong thing for what I told you is going on with me. And so, you know, that's kind of the way I look at it. So what this is here, if you can see this, this is the money supply. So M2 is the real money supply. And so when COVID hit, the money supply like shot up for a number of reasons. The Fed lowered rates to zero. They started buying mortgage-backed securities and doing a bunch of things on the long end. They increased their purchases and all that. And as you can see, their balance sheet went up. On the fiscal side, the government spent a whole bunch of money. They sent people checks and all that. They, you know, stimulated a bunch. And what did that do? That created inflation. Money velocity went down. Velocity of money is the money supply divided by GDP. And so obviously money supply goes up and GDP went down. So then, you know, it's just a smaller number there. And so here though, this is what concerns me. The real money supply is starting to creep up and the Fed's balance sheet is still elevated, which means there's still a lot of money in the system, which is why we haven't had a recession yet. But that's also why inflation is still high and will probably remain high. And this here is like the trend line of the money supply. And it jumped up, which is why it was so much pain. And now we're back, you know, sort of to a normal trend. But the Fed balance sheet needs to get back in balance too. Otherwise, you'll see, and we're ticking up here with inflation, and then the velocity of money is going to increase as well, which is, you know, each dollar getting turned over, which is a good thing. You want the velocity of money to be high, but you don't want the real. So so what creates that is a higher GDP and lower money supply. which is what we had over here. And so that's you know, kind of how I'm looking at it. And I don't see, with the incoming administration, if this pattern of a reduction in the real money supply to normal levels and a reduction of the Fed balance sheet will continue on the path that is appropriate to have a normalization in asset prices. So all that means is, you know, if you you want to go risk on, you know, go risk on, and if you are risk averse, buy puts, you know, buy some put spreads, sell some out of the money calls, collect some premium, you know, hedge your downside risk, but stay long at least over the next 12 months. And then, you know, those hedges, they may pay off in February, March. You know, if you get like a, you know, 60 to 90 day put spread or you know, out of the money puts to hedge that downside risk, because people are just buying and there's money there. Like, for prices to drop on anything, unemployment would need to go up, and the money supply, which is sloshing around in people's bank, would need to go down. There would need to be some increases in default rates, like the rate on, or here we go. It's easier to illustrate it, but the spread of investment grade bond rates over equivalent treasuries is like at the lowest it's been in years. And if we go back even more, you know, the last time it was that low was right before COVID. The last time it was that low was right before the Great Recession. You know, you get over here, it wasn't all the way that low, but I mean, you look out, you know, about a year ahead of the dot-com bubble. So that just means that people aren't being compensated for risk, because there's a perception that risk is small right now in the corporate bond market, meaning there's a lower risk of default that's being priced in. And if you look at high yield, same thing. Like, high yield spreads are like super tight. And that just means that, you know, the bond market buyers, like as an investor, we just got through talking about debt. As an investor, that means that your perception of default rates is low. And so you're not demanding a significant compensation above treasuries for your risk, because you don't feel like there's a high chance of default risk. That's great if you are looking for funding. Like, if I'm doing a deal, like, I think the M&A market, PE market, and, you know, some of the other, you know, private credit markets, although it's overly saturated at this point, like, it's lots of capital, like so much money trying to find a bunch of deals is gonna potentially, so people need exit events. So people have to, if you have a portfolio of deals and you need exits, so that's gonna improve the secondary market. But those prices, though, because they've been waiting so long, I'm not sure what price they're gonna get for those deals. There might be some discounts going on because volume is gonna pick up, but people will be more inclined to do deals because the cost of capital is lower, relatively speaking, with the Fed lowering interest rates and spreads being tight. You know, if you're in the market for debt financing, then yeah, I mean, you could issue new bonds and like go to market, and you're even on the high yield space, you're paying, you know, 2.6 above treasuries, or if you're investment grade, you're paying 0.7 above treasuries. It's like super low. Like, if I'm Apple or any of these, you know, any company in the S&P 500 is just foaming at the mouth, and they're just doing deals left and right. And M&A is going to pick up too, I think, going into next year as well. So Animal spirits, man.
Hey guys, before we go, this is Lamont Mitchell again. David, you talked about commodities and how gold is going to fluctuate. Are you familiar with rhodium and iridium? These are rare earth elements.
Yeah.
Okay, both of those go almost twice as much as gold right now. So they got you like basically with smoke and mirrors looking over here at the price of gold going up and down, but iridium and rhodium, I think in 2020, rhodium was up to almost $11,000 an ounce. It's one of the most used minerals other than gold. In your car, you start your car and your catalytic converter kicks in. Rhodium is within that system. Every automaker, uh, most jewelry companies, everybody uses rhodium, and they have us once again focusing on the right hand when the left hand is doing all the action. Gold is going to, of course, continue to move back and forth because that's what they use to measure the market. But if you look at the other commodities that are actually making more than gold, platinum is making a move right now, so is silver. I think that there's a lot more going on than what they're showing us. Just this year alone, the United States issued what $448 million to mining companies within America to start buying minerals within the country, seeing the tariffs going on in China, what's going on in other countries as well. So now they're closing the borders finally and saying, hey, we have enough minerals right here in our own country. And this is a great time for us to focus on what they're doing within the country. Lithium is also a hot topic. And they're also looking at a new form of lithium or extraction. It's called direct lithium extraction, DLE, where they take the salt out of salt water and use a grinding process and turn it into a higher grade lithium at a faster amount of time. So they have everything you see. I was a broker for 7 years. I'm a Series 7 to 63, and I was an investment banker. And I always used to look at what they put out there for everybody to see, and then I go look behind the scenes of what they're not really talking about. You know, with this Fed now, or I think it's the Fed dollar or the digital dollar that we're coming out with. They're trying to do away with the fiat dollar, which has been in place since 1971, because it's not backed by anything. That's why BRICS has come out with their digital dollar, and they're backing it with gold, so it has some type of work. But America, we can't be copycats again. We have to go beyond what they're showing us and figure it out for ourselves if we're going to get back to the top. So I like what you're saying, man. I look at like I said, I look at what they put in front of you and say, that's good. Thanks for telling me what you're doing. But then I go look at my own game plan and make sure that I hedge my bets, or my investments. So I'm not out here following the masses and being run to save face when they pull the rug from underneath you. So you got to watch be one step ahead of what they're doing, man. That's all I'm saying.
Oh yeah, I mean that's a great point. When you think when it comes to like the non developed countries, or let's say the BRICS specifically. So they've been since COVID really like actively recruiting other developing countries to, particularly after the Russian invasion of Ukraine, where the G7 used the SWIFT payment system to sanction and thwart funding to Russia for other commodities and other funding needs. That did help facilitate a lot of what you're talking about, and the BRICS in general saying, well, we not only do we want something that all of them have their own fiats anyway, but moving away from dollar pegs or dollar benchmarks in general, there's a whole concerted effort to go that way, and I'm with you. And said now, when implemented, is going to be a game changer for sure. And it's so many different things moving. It's so many moving parts. Like people don't want to be left behind. Like you have like the stable coins, you have the crypto side of things, and then you have like these other commodities like non-gold. When I look at gold versus non-gold, it's like you mentioned rhodium and the silver and some of the others. Those have industrial applications, and so a lot of them are tied to the ebb and flow of the business cycle. Like meaning if people still want to have cars and still drive, but like that's a good point. It's like, okay, well, from now until the full adoption of EVs, let's say 2040, there probably will be a sustained demand for silver and some of these other metals that you mentioned because they're so integrated into the clean energy and like lithium, the development and building of batteries and hydro applications. So yeah, that's an excellent point. So do you have you have like an ETF or like lithium or rhodium options or like a ETF in your portfolio that invests in those stocks? Do you have like any particular commodity producers or miners in mind?
Well, we're in the best part of what our purchase is. We have 4 PGM claims in Nevada, and they have like each have about 11 billion in gold and silver, but they're super rich or heavily saturated with rhodium and iridium. So you have 4 claims worth about 309 billion apiece in Nevada. So we have our hands on that. And as far as the lithium, we're partnering with a company out of Cyprus who creates the technology for decellularization, which basically is taking the salt out of salt water and turning it into fresh water. And with that process, once they do that, we take the salt they removed, put it through the brining process, and create high-grade lithium. That's what the direct lithium extraction process is. So we're looking to purchase 2 mining claims that are for sale as well. I'm sorry, salt claims that are for sale in the United States by one of the major companies in the country. And with the technology we have, we'll also clean up the environmental aspect of salt mining. It's very messy to the environment. And, it's an opportunity, especially for people that look like us, to get into a space that we haven't been in since, if you Google it and say how many African-American or Black-owned mining companies have there been in America, they're never going to give you an answer because they don't know of any, And for us to get in now with the opportunities that we have at hand, we have a firm grip on what we need to do moving forward. So, like I said, we're just securing the financing. I think we got a good resource here, and
Look,
we're gonna move.
I appreciate both of you guys. I mean, not only attending the session but staying on the class. I mean, everything happens for a reason.
I know, I appreciate it, but no, that's what I'm saying, man. It's I make sure I'm glad that Jewel and the brothers put this group together because I always said if I go to the table, I want to look around the table and see a bunch of brothers that look like me or sisters that look like me and understand that we are the change that's needed, the catalyst that's needed to get our communities back to take that $1.7 trillion that we spend as consumers and spend it as owners. That we instead of like they gave us reparations, we're gonna give it right back because we don't own anything of substance. Go give your money to Mercedes or Cadillac or Tesla and give them the money right back that they gave us. So it's time for us to change the narrative and say, okay, we own and that's the name of my company, War Holdings, and it stands for we own our legacy. So we're trying to bring the change that's needed to the table now. So
I love it.
Yeah. So yeah, man, I know you guys got to go, but I'm here for it all, man. I'm looking forward to us getting together as brothers and doing something super positive Some of you guys are probably too young, but I was there at the Million Man March, and it was a million of us there. You know, they try to discredit it, and it's not even celebrated in our calendar. You know, but yeah, it's time for us to really make a move, and this is the best time to do it, especially with this new regime coming in. So
Absolutely, absolutely. It's the outcome is the outcome, but based on the last administration, what I've seen, and all, it's almost like a musician where you don't like their behavior, but you love their music.
oh yeah,
I kind of look at that in a similar fashion to what we have going forward, meaning it's not going to be great in any stretch of the imagination from a social perspective in a lot of ways. I mean, I don't think it's going to be like catastrophic or anything like that, but there will be opportunities. And I think that the beauty in what you guys have talked about and discussed is that, this group is about looking at the opportunities. I mean, we know that there's always going to be things that are not favorable to us, but a lot of opportunities that are going to be coming our way over the next 12 to 18 months, just by the sheer things that are going to be changing in the administration, which is beneficial also. But,
yeah, I agree. I agree. I mean, with mining, the laws haven't changed since 1872. You know, it's the second longest standing laws that's been in place since the Constitution. You know, you have the Declaration of Independence, you have the Constitution, then you have the mining laws of 1872. That says a lot that they haven't changed in that long. I'm quite sure once they see our face come into place, they're going to be trying to scramble and change laws left and right. But we need to get in before they see us. You know what I mean? So yeah,
I agree. But yeah, it's been a pleasure, guys. I appreciate you joining, and like I said, definitely shoot me a message, and we can link up on Slack and outside of Slack and continue to build.
appreciate you, man. Thanks, guys. I appreciate all you guys.
All right, thank you. Take care. Good night.
You too.
Good night.
Bye-bye.